Okay, let's unpack this. If you drive a car, you pay insurance based on things that, well, sometimes feel like guesses, right? Where you park, your age, maybe even your credit score. But the industry's changing, and it's changing fast. It's all thanks to this influx of really specific data. Today, we are diving deep into insurance telematics. Basically, using technology could be an app, a little device, or even your car's own computer to gather real-time driving data. And that data, it informs how your insurance gets priced, how it's managed, and importantly, how claims are handled. Our mission here is to really dig into a comprehensive industry report. It details this explosive growth, the technology shifts, and the key players across Europe and North America, projecting all the way out to 2027.
And this deep dive is definitely needed. The report confirms telematics isn't, just some small side offering anymore. It's fundamentally reshaping risk management itself. We're looking at a global trend, multi-billion-dollar scale, and it's moving really quickly from just simple tracking devices towards, well, full integration with the whole connected car ecosystem. So if you're an investor, or maybe you're just a policyholder, or even an auto executive, the sheer speed and scale of this shift, it really demands attention.
Let's start with that scale then, because we're comparing two huge markets, Europe and North America. And their growth paths are, well, surprisingly different. Looking at the numbers from the end of 2022, Europe had about 13.6 million active policies using telematics. That's projected to grow pretty substantially, actually, to 20.7 million by 2027. That gives it a solid compound annual growth rate, a CGR of about 8.9%.
Okay, 8.9%, that's strong growth.
But then you look over at North America. They already had a slightly higher volume at the end of 2022, 16.8 million policies. But the projection for 2027, it's a massive 29.2 million active policies.
Right, and that 29.2 million figure for North America, that's really the big story here. That translates to an 11.7% CAGR over 5 years. That's significantly faster than Europe's 8.9%. It suggests, well, a much more aggressive, more widespread adoption strategy from U.S. and Canadian insurers.
So why is it steeper in North America? What's behind that faster adoption curve?
Yeah, it's a good question. Part of the answer seems to lie in market flexibility. In the U.S., insurers generally have a bit more freedom in how they price risk compared to, say, many European markets, which can be quite heavily regulated. This lets them offer bigger, quicker premium discounts. It's a strong incentive for customers like you to say, okay, yeah, I'll share my driving data. And that approach, it just rapidly scales up the number of people opting in.
Ah, okay. So it's not just about people being willing to use the tech. It's also the insurer's ability to immediately reward you for it with better pricing. Makes sense. The report does highlight that this adoption is kind of concentrated right now. The biggest markets globally are the US, Italy, the UK, and Canada. But we're seeing that really sharp upward trend, specifically in North America.
Exactly.
Now let's shift gears a bit and talk about the technology itself, because the source material we looked at details this pretty profound tech divide between the regions, and it helps explain those different growth rates we just talked about. So historically, Europe has been more about aftermarket black boxes, actual hardware professionally installed in the car. Whereas North America, they lean much more heavily towards mobile apps and these self-install OBD, onboard diagnostics devices, little plug-in things.
And this is a really critical point. That black box, it offered very high fidelity data, very reliable. Things like true acceleration, cornering forces, hard braking, stuff that was hard to fake because it was wired right in. But think about the cost of installing those. And the hassle, right? Scheduling appointments for millions of customers. That's a huge bottleneck if you want to scale up quickly. That hardware friction definitely limits growth potential.
Okay, so Europe went for data quality, North America went for scale.
Sort of, yeah. North America prioritized speed to scale. They embraced mobile apps. Now, maybe a mobile app sacrifices a tiny bit of that raw sensor fidelity compared to a hardwired box, sure. But it completely removes the friction. You download the app, you give consent, boom, you're enrolled. That ease of access directly fuels that higher stage GR we were just discussing.
But wait, doesn't relying on a phone introduce other issues? Like, what if the phone battery dies or someone puts it down while their friend is driving? Are they trading away too much data richness just for convenience?
That's a really important question about data quality, and it's actually where the big vendors have really stepped up. The future trend the report identifies is precisely the maturing of these smartphone solutions. It's not just basic GPS and accelerometer data anymore. They're using pretty sophisticated AI now, looking at contextual data too, like what was the weather, what were the traffic patterns when something happened. They're building surprisingly reliable risk profiles this way.
So the tech is catching up.
Exactly. The report specifically calls out key mobile players like Cambridge Mobile Telematics, CMT. They're apparently powering over 10 million policies already, mostly in the US. And another big one is Arity, which I believe is a subsidiary of Allstate. Their importance isn't just in building the app itself, but in pulling together this massive amount of mobile driving data. It makes the risk model smarter for everyone involved.
Okay, so the shift is clear then. Moving away from expensive, kind of clunky hardware towards software that's everywhere, scalable, and backed by AI to handle those data quality concerns. And that low barrier for you, the consumer, just feeds right into that faster growth we see in the U.S. market. Makes sense.
Okay.
So let's talk about who's actually pushing this forward. Who are the insurance power players really driving this adoption? Well, in North America, the list reads pretty much as you'd expect. It's dominated by the big household names, right?
Yeah, of course.
Progressive, Allstate, Liberty Mutual, Nationwide, State Farm over in the U.S. And up in Canada, you see giants like Intact Financial Corporation and Desjardins leading the charge. These guys saw the potential early on and invested heavily.
Right, a lot of familiar names there. But if we look across to Europe, okay, here's where it gets really interesting. Because the market structure is just drastically different. North America's fragmented, lots of big players. But Europe shows this extraordinary market concentration.
How concentrated are we talking?
Get this. The report reveals that two Italian insurers, UnipolSai and Generali, together account for approximately 50% of all telematics-enabled policies in Europe.
50%. Just two companies.
50%. Half the market, locked up in just two company portfolios.
Wow. Half the market in just two companies.
Yeah.
That's genuinely startling, especially when you think about innovation. Why Italy, though? What happened there to allow such huge consolidation so early?
Yeah, it's pretty unique. That concentration isn't really accidental. It's largely down to historical and regulatory factors. Italy was a very early adopter of telematics. Sometimes it was driven by government mandates or maybe strong incentives in areas with, say, high insurance fraud rates or really dense traffic. So that early adoption, combined with some market consolidation, basically allowed UnipolSai and Generali to build this huge technological lead, like a moat around their business. It made it incredibly tough for smaller players to catch up later on. They hit critical mass years ago.
So they had a head start and just ran with it.
Pretty much. Now, in the UK, you also see strong leaders like Admiral Group and Direct Line are mentioned. But that Italian situation, with 50% market share, it's really unique globally. And these dominant firms, they're using the telematics data for, well, multiple things. Much better pricing, obviously, way more efficient claims management. I mean, they get crash data almost instantly, and they use that personalized risk pricing as a powerful tool to keep customers, too. They're fundamentally reshaping their businesses around this data advantage.
Okay, that Italian example is definitely eye-opening. This brings us nicely to what the report calls the key enablers. This is all about the changing role of the car manufacturers themselves, the OEMs, and this huge tech challenge of data normalization. The relationship between the car world and the insurance world is seriously changing. The report lists several big automotive OEMs launching solutions specifically to facilitate usage-based insurance, or UBI. We're talking Ford, General Motors, Mercedes-Benz, Stellantis, Tesla,
Yeah, the
Toyota.
big ones.
Exactly. They're not just selling you a car anymore. They're helping provide an insurance product using their own connected car apps. It brings the car maker right into your financial relationship with your vehicle.
But this immediately creates a critical question, right? How does an insurer deal with the sheer volume, and especially the variety, of data coming from, say, a Tesla versus a GM vehicle versus a Toyota? A Tesla might report a sensor reading one way, maybe steering wheel angle X, while a Toyota reports the same basic thing as lateral input Y. If every insurer had to write custom software just to understand every single car brand, well, the whole system would just fall apart. It's not scalable.
It sounds like a digital Tower of Babel for car data.
That's a perfect analogy, and this is exactly where data normalization becomes absolutely critical in this whole value chain. You've got all these cars speaking different sensor dialects. The data providers, they act like the universal translators. They're the Rosetta Stone for the insurance world.
Okay, so the car generates the raw data, but it's kind of useless to the insurer until someone translates it into a standard language they can understand.
Precisely. The report highlights the key players doing this vital plumbing work. Companies like LexisNexis Risk Solutions, Verisk, and CCC Information Services. These are the data normalizers. They partner directly with the OEMs. Their job is to take that complex, raw vehicle data diagnostic codes, sensor outputs, you name it, and translate it. They turn it into usable, standardized risk information that basically any insurer can just plug straight into their existing pricing models.
So the power dynamic is shifting. The OEM controls the data fire hose, and these normalizers control the taps, making it usable for insurance.
That's a good way to put it. The OEM controls the primary stream, and the normalizers are like the gatekeepers making that stream understandable and valuable to the whole insurance industry.
And crucially, this brings us right back to you, the policyholder, because all of this complex machinery from the sensor in your car through the OEM to the normalizer, finally to the insurer, none of it works
Unless the policyholder gives explicit consent to share their driving data.
Right. That consent piece is maybe the single most important constraint mentioned in the source material we reviewed.
It really is. And it raises an important question, doesn't it? As this whole network expands and the price advantage of using UBI becomes potentially overwhelming, how much real choice will be left for you if you want to keep your driving data private? Think about the shift. It used to be installing a physical black box, a conscious action. Now it's moving towards maybe just ticking a box on your car's dashboard screen. It feels much more passive, that consent, and it's accelerating.
That really is the core tension for the future of car ownership right there. Okay, so let's try and wrap this up for everyone listening. The key findings from this deep dive seem undeniably clear. First, telematics is hitting hyperscale, especially in North America. Remember that 11.7% CAGR, driven by market flexibility and just making it easy for people to sign up.
Low friction adoption.
Second, the tech itself is fundamentally shifting. We're moving away from that expensive bottlenecked hardware towards scalable software, mostly mobile apps, but increasingly, deep integration with the data coming directly from the car manufacturers, the OEMs.
Yeah, the OEM data is becoming huge.
And finally, that means the car manufacturers are now central partners. They're working hand in glove with those data normalizers. We mentioned LexisNexis, Verisk, CCC, bridging the gap between how you drive and what you pay for insurance each month.
So the final thought, perhaps. If usage-based insurance relies entirely on data you consent to share, we really have to consider the longer-term implications of this whole new value chain. Given the rapid integration and normalization the report shows, how much more integrated will your vehicle's data become with all sorts of everyday financial decisions? Think beyond just insurance, maybe vehicle financing, maybe warranty claims. How integrated will it be by 2027? We're definitely moving toward the vehicle that's constantly reporting on its own risk and how it's being used.
Yeah, it really makes you wonder how long it might be until maybe the cheapest insurance policy also requires you to let the OEM use that same driving data to decide if you're eligible for a future warranty claim. Definitely something to mull over as these OEM partnerships deepen and data becomes, well, the ultimate currency of owning a car.